Funded accounts have changed the entry point into professional trading in a way that didn't exist a decade ago. The ability to access a $5, $10, or $200,000 account by proving your ability across a challenge phase without putting that capital at risk yourself is genuinely one of the most accessible paths into serious trading that has ever existed. And yet the way most traders approach them completely undermines that opportunity. They treat the challenge like a sprint. They rush through it, over-leverage to hit the price targets fast, cut corners on the rules they'd normally follow, because the goal is to pass, not to trade well. And when they pass that way, they carry those same habits into the funded account. The luck that got them through the challenge doesn't scale. The account fails, they buy another challenge, and the cycle repeats. A funded account is not a shortcut to trading income. It is an opportunity to build real skills, develop real emotional control, and prove to yourself, with data, that your approach is worth backing with serious capital. Used that way, it is one of the best tools available to a developing trader. Used as a lottery ticket, it costs money and teaches nothing. Today we're going into the truth about funded accounts, what they're actually for, what it means when you fail one, how to approach the challenge phases correctly, and what the funded account journey looks like for traders who eventually make it work. But before anything else, let's be precise about what a funded account program actually is, because misunderstanding the purpose is where most traders go wrong from the start. A funded account is not free money. It is not a cheat code that lets you skip the development process. It is a structured evaluation, a firm saying, prove you can trade with discipline and consistency across a defined set of rules and conditions, and we'll back you with real capital and take the downside risk ourselves. That structure, the rules, the drawdown limits, the profit targets, the consistency requirements, is not bureaucracy. It is the evaluation criteria for whether you are actually ready to manage institutional capital. Every rule in a funded account challenge exists because the firm needs to know that the trader behind the account won't blow it in a single session of emotional trading. The daily loss limit isn't arbitrary. It's a test of whether you can control risk under pressure. The consistency requirement isn't inconvenient. It's a test of whether your results are reproducible rather than lucky. The traders who approach funded accounts with that understanding, as a genuine evaluation of real trading readiness, are the ones who eventually pass and keep the accounts they earn. The traders who approach it as an obstacle between them and the money are the ones who pass by luck, fail the funded account quickly, and repeat the cycle indefinitely, wondering why it keeps happening. The funded account doesn't create a trader. It reveals one. And what it reveals is whatever the development process that came before it actually produced. One of the most important things to understand about funded account trading, and something that surprises a lot of traders when they first experience it, is that the emotional intensity of trading a funded account is not significantly different from trading your own money. On the surface, this shouldn't be true. The capital isn't yours. If the account fails, you lose the cost of the challenge fee, not the full account balance. The financial exposure is limited. And yet the experience of sitting in a funded account trade that's moving against you, watching the balance approach a drawdown limit, knowing that a rule breach ends the account, that experience produces the same cortisol response, the same amygdala firing, the same prefrontal cortex suppression that we've covered throughout this channel. The brain doesn't cleanly separate my money from money I'm responsible for. The responsibility itself is enough to activate the full psychological response. But that's what we want. This is actually valuable information. This means that the funded account challenge is genuine psychological training, not a simulation, not a dry run, but real emotional exposure in a real market environment with real consequences. The anxiety of approaching a daily loss limit, the temptation to oversize a position to hit a profit target faster, the frustration of a losing day when you were close to passing. These are all the emotions and more that you would experience of live trading, but experienced at a lower financial starting cost. The trader who recognizes this, who treats each funded account challenge as a genuine emotional training environment rather than a box to tick, is extracting the full value of the opportunity. Every session where they hold the rules under pressure, every drawdown they manage without breaching a limit, every profit target they reach through disciplined execution rather than lucky oversizing, all of that is building the psychological foundation that live funded trading actually requires. Here's the pattern that plays out more often than any other in funded account trading, and it's the one that keeps traders on a treadmill of buying challenges, passing badly, losing funded accounts, and buying more challenges without ever actually improving. The challenge has a profit target, 10%, 8%, whatever the specific firm requires. And the trader, seeing that target, starts doing math. If I risk more per trade, I can hit it faster. If I find one or two big setups and size up significantly, I can be done in a week. The thought process is entirely outcome-focused. What's the fastest path from here to passing, rather than process-focused? What's the most disciplined, repeatable path to proving I can trade this account correctly? So they overleverage. They take setups they wouldn't normally take because the potential gain moves the needle. They hold through drawdowns they'd normally cut because they need the full move to hit the target. And sometimes, not always, but sometimes, this works. The target gets hit. The account is passed. And the trader celebrates as though they've proven something. They haven't. They've proven that they can get lucky in a challenge environment. And the funded account, which operates under the same rules but over a longer period and without the sprint mentality, quickly reveals that distinction. The same over-leveraging that passed the challenge now breaches the funded account's maximum drawdown. The same emotional decision-making that hit the target once produces a losing month. The account fails. And the trader is genuinely confused. They passed the challenge. They followed the same approach. Why didn't it work? Because passing a challenge through luck is not the same as being ready to trade a funded account. The challenge is supposed to be proof of readiness. Passing it by bypassing that proof doesn't make you ready. It makes you someone who passed a test without learning the material. Take your time. There is no prize for passing the challenge in the shortest number of days. The prize is the funded account. And the funded account only stays funded if the trading that earned it was built on something real. At some point in the funded account journey, whether during the challenge phase or after passing, you will fail an account. Not might, will. And understanding what that means and what it doesn't is one of the most important psychological reframes a developing trader can make. A failed account is not evidence that you can't trade. It is not proof that the goal is out of reach. It is not a reason to quit, to switch strategies, or to conclude that funded trading isn't for you. It is data. Specific, actionable, honest data about where the current level of your trading, your strategy, your emotional control, your rule adherence under pressure, falls short of what's required to manage a live funded account consistently. Every trader who has reached the point of genuine funded account consistency failed accounts on the way there. Not some of them, all of them. The failure isn't the anomaly in the success story, it's part of it. The accounts that were lost taught things that the accounts that were kept built on. The discipline failures became the moments of genuine reflection that produced the improvements that eventually made consistency possible. What separates the traders who eventually break through from the ones who cycle through challenges indefinitely is not that one group fails less. It's that one group extracts more from each failure. They review the account with the same honest, structured analysis they'd bring to a losing trade. What rule was broken, and why? What emotional state produced the breach? What would have to change? In the strategy, in the pre-session preparation, in the in-session emotional management, for this specific failure not to repeat? A failed account with a thorough post-mortem is worth more than a past challenge with no reflection. Because one produces improvement and one produces nothing except a new starting balance. Use the failure. Extract everything it has to teach. And come back to the next challenge not with the same approach hoping for better luck, but with a specific, documented improvement that addresses the specific, documented reason the last account ended. So what does a correctly approached funded account challenge actually look like? Not in terms of strategy, every trader's approach will differ, but in terms of mindset and process. The first thing is treating every session of the challenge exactly as you would a session on a live, funded account. Not, I'll be more careful once I pass. The same daily loss limit discipline. The same criteria for entry. The same position sizing. The same pre-session preparation. The same post-session review. If you can't trade the challenge with the discipline the funded account requires, you haven't earned the funded account. And if you do trade it that way, if you hold that standard across every session of the challenge, then passing is a byproduct of trading correctly, not a goal you're forcing toward. The second thing is setting a personal daily loss limit that is stricter than the firm's. If the challenge allows a 5% daily drawdown, trade as though your personal limit is 1%. This does two things. It builds the habit of protecting capital that live funded trading demands. And it gives you a buffer. If you have a genuinely bad session, you can absorb it within your personal limit without breaching the firm's rule and ending the challenge. The traders who consistently stay well inside the firm's limits are the ones who never have to worry about them. The third thing is time horizon. A funded account challenge is not a sprint. It is not designed to be completed in a week. It is designed to give you enough sessions across enough market conditions to produce a meaningful sample of your trading. If it takes 30 sessions to pass because you traded conservatively and consistently across all 30, that is the ideal outcome. Not the fastest outcome, the ideal one. Because those 30 sessions of disciplined execution are 30 data points proving that your approach is real and repeatable. That evidence is worth far more than a challenge passed in 5 sessions by overleveraging. The fourth thing, and this is the mindset shift that changes everything, is to stop measuring progress by proximity to the profit target and start measuring it by the quality of execution in each session. After every challenge session, ask not, how much closer am I to passing? But, did I trade today the way a funded trader should? If the answer is consistently yes, the target will come. If the answer is consistently no, the target is irrelevant, because passing a challenge that way doesn't produce a funded trader. It produces a lucky one. The funded account is one of the best opportunities available to a developing trader. It removes the barrier of needing significant personal capital to trade meaningful size. It provides a structured, rule-based environment that teaches discipline in a way that self-funded trading without guardrails often doesn't. And it creates genuine emotional exposure. Real pressure, real consequences, real psychological training. At a fraction of the financial cost of learning those lessons with your own money. But it only delivers those benefits if it's approached correctly. Not as a lottery, not as an obstacle, as what it actually is. A structured proof of readiness that you build toward with real work, real strategy development, and real emotional development. That takes time. It takes failing accounts and learning from them. It takes discipline in challenge sessions when the faster path is available but the wrong one. The traders who eventually build something real with funded accounts are not the ones who pass the fastest or the ones who never failed a challenge. They're the ones who understood what the process was for and used every part of it, including the failures, to become the trader the funded account required them to be.